HIMS and Hers Health is falling here in the after hours, down nearly 5% after reporting its Q1 earnings. And today we are going to talk about it. We're going to talk about the quarter that just was. Did they beat? Did they raise? Is HIMS a buy right now? And what is the underlying momentum of the business? Is it getting better, or are the fundamentals deteriorating, warranting this sell-off in the after hours? We're going to talk about it all. But before we do that, if you could please go ahead, like and subscribe. It really helps me out. Now, it was business as usual for HIMS, the growth company, just on an absolute tear. Revenue was up 111%, beating the analyst expectations of 536 million. The company did miss on earnings per share. Analysts were expecting 22 cents. EPS came in at 20 cents. However, you're still looking at 300% year-over-year growth, when in the same quarter last year, HIMS reported 5 cents in earnings per share. So the company is growing like a weed. This is where the trouble starts with HIMS and why the stock was down 4% in the after hours. The midpoint of the revenue guide, 540 million, missed the Q2 revenue expectations. Q2 EBITDA guide was roughly in line. However, despite this miss, the company reaffirmed the full year guide for revenue and EBITDA. Looking at the quarter as a whole, we did see gross margins decrease. So this essentially means the growth in cost of goods or cost of revenue is increasing quicker than actual revenue as a whole. So HIMS as a whole is sacrificing margins for growth, not uncommon in growth stocks like HIMS that are growing triple digits on a year-over-year basis. EBITDA margins nearly doubled. In fact, more than doubled. Free cash flow margins nearly doubled. You could see EBITDA last quarter was 30 million. I know that's a B. It should be million. They reported 66 million, guys. Absolutely insane. Look at free cash flow from 15.2 million to 53.7 million. So this is a profitable business growing at an insane pace. And they're doing that with minimal debt on the balance sheet, 63 million in debt, 322 million in cash. That is the type of financial position you want to see when the growth profile looks like this. So when we actually look at where did the growth come from, I thought it was very healthy, all things considered. When you look at subscribers, look, last year versus this year, they saw a 38% increase. So there is actually just volume. It's not just price increases. And then monthly online revenue per subscriber is 84. So this is why the company is growing so quickly, right? When you have subscribers increasing, when you have an increase in volume and you actually have an increase in the amount they're spending, you get that double whammy of growth. And this is why the company is growing so quickly. You could see online revenue was up 115% on a year-over-year basis. That makes up the lion's share of their revenue. Wholesale revenue actually decreased 7%. And I think you should expect that to continue to decrease because they're going to be relying less and less on wholesale as a whole. And then total revenue for the quarter was 586 million, as you guys can see right there. Now, diving more granularly into the financials, you could see here that revenue increased 115%. The cost of revenue, however, increased 216%, and that is why we actually saw gross margin contraction in a very significant way. However, the company did a great job at controlling expenses. Operating expenses were only up 69%. That's very solid, especially for a growth company. And that resulted in net income increasing 344% on a year-over-year basis. However, earnings per share only increased 300% from 5 cents to 20 cents, simply because the company issued 7.8% more shares. So a lot of stock-based compensation going on. Nonetheless, that stock-based compensation is being put to good use because net income is growing significantly. And it means the people actually getting this stock-based compensation, the management teams, the underlying employees are doing the work and providing the value for shareholders. And then looking at some other highlights I just saw from the earnings report, right? Guys, this is a company firing on all cylinders. There is nothing wrong with this company, regardless of what's actually happening in the after hours. Personalized treatments, right, was adopted by 60% of subscribers, which achieved over 80% use in dermatology, raising retention by 20 points and driving 45 and 170% growth in men's and women's hair loss. That is absolutely insane. So personalized treatments is sort of like they do customized treatments for specific individuals and then ship it out on a month-over-month basis. This is higher margin than their generic treatments. Weight loss experienced over 300% year-over-year subscriber growth, and this was strengthened by Novo Nordisk's partnership. So HIMS and Hers, due to GLP-1 shortages, they were able to compound semaglutide and sell it to their customers. They are no longer able to do that because GLP-1s are no more in short supply. However, they have partnered with Novo Nordisk to provide Wegovy, their GLP-1 drug offering. Sexual health solutions still doubled, so reaching 40% of subscribers. This is absolutely insane growth. And the acquisition of an at-home lab testing provider enables low-friction testing, setting the stage for new low testosterone and menopause specialties by the end to serve over 50 million affected individuals in the US. And guys, I think that HIMS is going to keep growing because every single medication or treatment under the sun, their platform is going to eventually offer. And this is why their 2030 financial guidance was absolutely insane. They said that they expect to do revenue of $6.5 billion by 2030 and adjusted EBITDA of $1.3 billion. Just for comparisons, they're looking at doing about $2.4 billion in revenue. You're looking at hundreds of percent in revenue growth as well as adjusted EBITDA. Now, for the second quarter, they said they were looking at these figures right here. We spoke about it earlier. And then for the full year 2025, they're looking at 2.3 to 2.4 billion and adjusted EBITDA of 300 to 335 million. So look, this company is still looking to grow very, very quickly. And it's looking like the management are seeing the growth into 2030, especially with all of the treatments that'll just keep getting added to the platform. And it just expands their TAM more and more. Now, things to watch, I think ultimately you want to watch growth, particularly growth in subscribers and how much they're paying for each of those medications. If subscribers keep growing and they keep paying more, that means the moat is intact. However, if growth slows or subscribers start paying less, that means discounting is happening and there's other providers eating into their moat. The other thing you want to watch is margins, particularly gross margin. Is it going to contract like it has this quarter, or was that a one-off situation? And then you also want to look at competition. Now, they do have one other competition like Ro, Amazon Pharmacy. You do want to keep an eye on this because the barriers to entry in this business model are not that high. Now, I do think that HIMS' moat is potentially widening as they secure partnerships and keep expanding their moat, and the thesis is intact. Now, where does that leave us with valuation? The company trades at elevated valuation levels, EV to EBITDA of about 30 times, price to earnings of about 38 times, but they are growing like a weed, and they do have a shareholder yield of 115%. So when you look at these, it doesn't look super attractive. When you actually look at the returns you can expect over the next 5 years, if we then plug in 2029 revenue of 5.4 billion, so I am building in a margin of safety for the HIMS product, you can probably expect about 6 billion in revenue for 2029 and then 6.5 in 2030, but we're going to use 5.4 just with a bit of margin of safety. So that would mean growth continues to remain at about 25% through 2029. We're looking at EBITDA margins of 14%, which is again what management have guided for. Current margins are 8%, so we are looking to expand margins into 2029. And then if we use an EBITDA multiple of 20 in 2029, the current EV to EBITDA multiple, like I just showed you, is about 38 times. So we are looking at some margin contraction. Then you subtract the net debt, you get the equity value, divide by shares outstanding, which are going to increase 1% every single year. In 2029, you get a stock price of $68, and that would represent about a 10% compounded annual return in 2029, coming well below consensus. And if the company starts buying back shares, if growth comes in significantly higher, if margins actually expand more than this, right, this figure may actually look conservative in hindsight. So is HIMS a buy right now? I would say probably yes. If you do have a very, very long-term time horizon, I would probably start dollar cost averaging, because it does look like this may be the baseline, or potentially even the bear case is for about 10% projected returns over the next 5 years. Very, very solid. And this is a theme that's going to be growing in perpetuity. Healthcare is something people will always need. Looking at the technical charts, I would say that if you are looking to get into HIMS, if the stock does pull back below the 32 mark and above the 24 mark, this is probably the zone where you want to get in. You can see we use it as resistance multiple times right here. Then we broke above, used this top edge as resistance, then this bottom as support. And we do know that resistance turns into support. We had this blow off rally very close to $80 per share. We've pulled back and bounced at this exact same spot right there at $24 mark, and we've rallied since. Now, if we do pull back, potentially we could use the 32 mark as a resistance zone for us to make the next move higher. and the stock will continue to remain volatile and shoot above its fair value, both to the upside and downside, just because of the nature of the stock. Nonetheless, I do think there's more upside to HIMS. This is a high growth stock, very volatile, but I do think if you can handle the volatility, this is a great buy right now. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.